Investing has become one of the most discussed topics for Indians globally. The real question to ask is how should Indians look at investing today? To unpack that, I am with Mr. Varun Sanan, the Senior Vice President and Head of International Sales for Edelweiss AMC. We'll talk about three things. First, you as someone experienced, how do you look at this investments, investing personally? What do you suggest to people? Second, how should Indians react to the market conditions? And third, how Indians and NRIs should actually look at investing.
Sure.
How different would you say is the mindset of a retail investor and HNI or an institutional investor?
It's the same.
Same?
Everyone is chasing returns. Sometimes that we sit back and scratch our heads that how did we end up here?
What do you think is the mindset of an investor?
So,
Investing has become one of the most discussed topics for Indians globally, be it investing from India or investing back into India from abroad. With markets evolving and global opportunities opening up new avenues of investing, the real question to ask is how should Indians look at investing today? To unpack that, I am with someone who has spent over a decade with investors globally. Welcome to another episode of the Home Advantage by Belong. My name is Pallav and I am with Mr. Varun Sanan, the Senior Vice President and Head of International Sales for Edelweiss AMC. Hi Varun.
hi Pallav.
Good to have you here.
Same here. Thank you for getting me over.
Perfect. This is a particularly interesting moment for Indian investors across the world. Indians are looking at investing globally, diversifying globally. At the same time, NRIs are reconnecting back to India, right? This is a good time to step back and rethink how all these Indians globally are looking at investing in the first place. In this conversation, we'll not talk about any particular products or any market calls. We'll talk about three things. First, you as someone experienced in retail banking, in investments, how do you look at this investments, investing personally? What do you suggest to people? Second, how should Indians globally as well react to the market conditions, like given the geopolitical issues, how the government is having the policies, and so on? How should they react to it? And third, how Indians and NRIs should actually look at investing.
Sure. Let me take your memory back. It was 2005. The first big bull run had just started, and stock markets were becoming hot. Everyone wanted to be a part of it, and India was on this big, path of reforms. And we had this big rally from 2005-6, and it just peaked in 2007. And that's when everyone wanted to, invest. There was dearth of advisors. People wanted to invest in the market. There was not enough knowledge, not enough platforms, so to speak. And that's when I realized that this is something that is a very long-term career. It's something where, once you get in and you start building trust and confidence, you also learn along the way because markets have different cycles. And as you keep learning, every day is a new learning.
Yeah.
And every day is quite challenging. And that is what really, really caught my interest. And that's when I figured that this is my calling now. And here I am, 20 years hence.
That's great. I mean, even for me personally, I don't come from a finance background. But since I have started working in this space, I am quite, I don't have the words for it, right? But I do see a very long-term career for myself in this because, like you said, there's so much to learn on a daily basis. There's just there's so much around markets, customers, policies. It's endless, right? Which is why even personally, I'm very excited for this. How different would you say is the mindset of a retail investor and HNI or an institutional investor?
It's the same.
Same?
Everyone is chasing returns. It's exactly the same. It just depends on who is at what part of the cycle. But I kid you not, mostly everyone, 99% of the people out there, you'll find just a fraction of people who are trying to do things differently. But all of them are trying to chase returns. And that is where, advisors like yourselves, us, we come in and try to make sense of the madness. But most people are doing or chasing exactly the same thing.
So, if I had to put this into words, right? So, what investors really want to do and what they actually end up doing is quite different,
Absolutely
right?
correct.
Everyone is talking about being patient in markets, right? Investing in right assets and diversifying, but it's all about returns. They think what happened over the last 1 year would also happen in the next 1 year
Correct.
as well. But I think which is not the case.
Yeah.
Might be true, might not be true,
Correct.
but that's obviously not the right way to think about
Yeah.
things, right? Now, given that you have worked with Indian investors, right, how do you think these guys approach risk and opportunity, right? Because there are people in different age brackets. For me, someone at my age, I'm okay with taking a higher risk. I'm clearly about returns. For someone who is, let's say, above 50, they're more like, I want to put money into liquid funds or FDs or any other physical assets like gold. What do you think is the mindset of an investor?
So this is what books have taught us. Okay, somebody who's upwards of 50, coming close to their retirement, should have less equity.
Yeah.
And the basic thumb rule is your age minus 100 should be your equity allocation. So if you are 25, you should have 75% equity. If you are 60, you should have 40% equity, which is not the case. The reality is far from that. Most investors start becoming far more aggressive when they are in their 60s, which is absolutely contra to what we believe, because a lot of those investors have taken care of all or most of their financial responsibilities. Kids are educated and married, homes are built, cars are standing outside, and they've got a decent enough retirement corpus. But what is also the big thing that's coming about is greed. Everyone wants to chase returns. So even those guys are upwards of 60-70%. In some cases, I've seen 80-90% into equities. So, unlike what textbooks have taught us, the reality is far from it.
This is an interesting statistic, right? So, in your opinion, do you think someone at that age should really enter into the security markets? Because the long-term compounding effects, will they come into picture for them? Because it also depends on how long they live, what is the lifeline looking like, right? They might not be able to get the desired returns or enjoy those returns in the first place, right? For example, someone at 30, he has a good amount of time to invest till he's 60 or 65, and he'll obviously make a very decent corpus at that end of that time. Is it the case same for these people who are above 55 or 60?
So, I think, Pallav, how it works is everyone should be in equities, and bulk of their portfolio should be in equities, because the way the world functions, inflation will always come about. And right now we're in a high inflationary environment with what's happened around tariffs and what's happened with the US putting tariffs. We're in anyways a high inflationary environment. In a lot of these kind of markets or these kind of scenarios, investors are better off being in equities. Now, what you have to really think about is what kind of equities, because equities start all the way from an equity fund is an equity savings fund, which has just about 30% equity, to a large cap fund which has 100% equity but invested in stable large cap companies, to a small and a micro cap fund which is investing in very volatile new age companies who have, you know, cash flows which are not very stable, business incomes which are not very stable. They're still trying to build and do all of that. So from an equity savings all the way to a small micro cap, that's the gamut of equity products out there.
Yeah.
Now, basis that, investors have to really be cautious on where they're going. So if there is an investor who's in his 50s, I would not say don't get into equities. Please do get into equities, but don't get into mid and small caps.
Yeah.
Get into hybrid funds, get into large cap funds, have Nifty 50, which is the Nifty 50 ETF, or Nifty 50 index fund, which is the pseudo for the index that represents our largest companies. So do that. Be mindful of what kind of equity product you're getting into, and that's the point that goes back to the first question initially that you asked me about risk.
Yeah.
That's when risk comes on the table. Evaluation of risk is very, very important. And unfortunately, what happens is most people forget about risk. They're just seeing returns.
Yeah.
Because reward has a price to pay. And that price to pay is risk. The higher the reward, the higher the risk. And that is what investors should lay down on the table and then evaluate what is it that they want to invest in.
Understood. Quite an interesting perspective here. So now that you talked about how you think of people who invest, right? I would like to know how you look at investing in your personal capacity, right? What has your thought process been since you started investing, let's say maybe in your early career, and now that you have spent over a decade in this industry, how do you think about investing?
So, over the last 20 years plus of my investing journey, my portfolio, if you see my portfolio 20 years back to what it is today, very, very different.
Yeah.
It's also to do with the fact that I've understood investing more now. I've understood risks attached to markets in greater detail. So if I'm 20 years back, my portfolio was all mid and small cap and the most aggressive funds.
Yeah.
I was also one of those retail investors who was only chasing returns. I would plot which is the number one fund and go after it. That is not the case today. Today, the portfolio is not mid and small cap alone. Yes, it is a part of my portfolio, but my portfolio is spread into international equities, where I've invested in US and China,
Yeah.
Which are big markets. I've invested in India through Flexi Cap, which are a good mix of large and mid and small. I've got mid cap funds and small cap funds for alpha generation. I've also got a couple of sectoral funds, which I think are long-term compounders. Say, for example, infrastructure. India's deficit of infrastructure, and over the next 5-10 years, with a lot of impetus of the government on infrastructure spending, a lot of these infrastructure companies are going to do very, very well. I've invested in banking and financial services funds. Because I believe that those companies are the backbone of any economy. If an economy has to grow, it has to be supported by the banks in that country. And if the banks do well, then only the economy will be able to do well. And if we're in that structural uptrend of the Indian economy, banks should do well, right?
Yeah.
So, and banks are low risk because in terms of the valuation metrics, if you look at price to earnings or price to book, which in a sense are determinants of how expensive you're buying into something, they are fairly fair in terms of their valuation, unlike a lot of other parts of the market which are in excess. So I've got those funds as well. And I've got fixed income funds, which are for liquidity and which are for stability in the portfolio. So that's how my portfolio currently looks.
Understood. You mentioned the P to E ratio, right? Price to earnings ratio.
Yeah.
For the audience, would you like to explain in layman terms, like what is this P to E ratio? How can they use it as a signal to buy equities? What conclusions can they draw from that?
So you can't track stocks or companies on their price to earning, look at the larger market, Nifty 50's price to earning.
Yeah.
To put context for people, Nifty 50's long-term average, 10-year average of price to earnings is close to 18 times. Today, it's trading at about 21, 22 times between that, which means you're paying higher than its long-term average. So the chances of making returns over the next 3-5 years may be lower. So if you want to enter the markets today, don't enter with a short-term horizon.
Yeah.
Enter with a long-term horizon.
Got
So
it.
that's the significance of price to earnings.
Understood. And like you said, not everyone follows the same rule for investing, because we have also seen in the recent years, like when the tech boom has happened in India, the IPOs are coming up for tech companies. The price to earnings ratios are quite high at the stage of IPOs, but still these IPOs see a lot of demand from the
Yeah.
retail investors at least. So that's a signal that that ratio is not something that people are significantly looking at. It might have been the case couple of years back, maybe 10 years back, but not currently, and it's mostly a long-term horizon that people are
Yeah.
betting on
Yeah.
at this point of time. So let's talk about investing in India and globally, right? You mentioned that you have a portfolio in India, looking obviously diversified, right? What do you think of this India growth story? What do you think it's going to be for the next 10 years, 15 years, or 30 years horizon?
I think most of us in the world of investing are very, very bullish on the India growth story.
Yeah.
And we're bullish because of 3-4 very, very concrete reasons. The number one is global growth is slowing down. Across the world, countries were growing very, very rapidly 20 years back. They have peaked. And growth engines are changing now. So if you looked at the decades from 60s all the way to 2000, the real growth engine of the world was the US.
Yeah.
Once 2000 happened, US growth started coming off because the base had expanded. The GDP of America had become fairly, fairly large. The growth engine changed. It changed to China. And China was manufacturing everything for the world. They became the factory to the world. And the Chinese GDP was growing very, very rapidly. It was growing around 9% year on year for almost 15 years. And that was the growth engine. And that's when Chinese markets did really, really well. That growth engine is now changed to India.
Yeah.
And so global growth slowing down, that growth engine is changed to India. Now, why has that growth engine changed to India? 3-4 basic reasons. Number one being our demographics. We're the country with the largest working age population. Our average population is in the vicinity of about 27 years.
Yeah.
European countries don't have working age population. They're in the vicinity of 45 plus. Japan, for example, has very little working age population. Countries like China, where there are people who have, where the working age population is low and who also have a lot of people to be added to the workforce, are aging. They were at this cusp 15 years back. Where we are today, Chinese average population age was 27, 15 years back. But also because China has become richer, now the labor force there is demanding far more salary than compared to India, right? So we have a huge working age population, which is cheap labor. And factories can be set up here. Global manufacturing can be set up here. And they will get the labor force, which is skilled and not very expensive. That is one very big reason. The other very big reason is that over the last 10 years, there's been a lot of policies that have come about in terms of, if you look at PLI, which is a scheme by the government to incentivize manufacturing, or if you see the banking reforms, how the banking reforms have really, really taken shape, a lot of land reforms. So the government's done tax reforms. Corporate tax cut was a big one. So the government's done so much work around policy that it also tells a lot of global investors that this is the place to set up businesses. They are very pro policy.
Yeah.
They've got the right talent pool, and they've got resources also to make all of that come together. And that is a very deadly cocktail for any country's economic growth.
Yeah.
And within that, India is probably standing head and shoulders above the world. Now, as all of that happens, what will also happen is we will just go the China way, where they had cheap labor once upon a time, and they could make all of those really, really cheap clothes, counterfeit Nikes, and a lot of cheap plastic toys, etc., etc. Very low tech, but they were making a lot of that. India's there right now. We are making low tech stuff. We're not making the highest end of semiconductors today. A lot of those economies like China, like Taiwan, like South Korea went through the same transition. And once their population started getting richer, that is when they started putting high end, because capital was available then.
Yeah.
And that's when they started putting high end manufacturing. Taiwan, for example, has a company called TSMC, which is one of the premier semiconductor companies in the world. China makes the best electric vehicles. They can compete with Tesla and probably be better than a Tesla. That's huge technology. The best phones, the best laptops, iPads are made in China. So a lot of that tech stuff that is happening there, the low end stuff is now shifting out of China. And that's where India benefits on that China plus one. Followed by the fact that all of this is also coming together at a time where the biggest economy, which is US, is putting tariffs, and they want a substitute to China. And that's where India fits in beautifully, because we've got rest of it. And now US is our friend. So, all of that will stem about to this big India growth story over the next 5-10 years.
Interesting. Now that you have explained how you see India growing the next 5-10 years, right? What do you think the right bet on India would be? The question here is, US, we took a bet on tech.
Yeah.
China was manufacturing. What do you think will be the case in India? Do you think it's a mix of both, or something individually, or something else altogether?
I think it's a lot of businesses, because unlike some parts of the world which are heavy on one sector, say some of the Southeast Asian countries are heavy on tourism. There are countries like South Korea and Taiwan which are heavy on electronics. There are countries which are very financially very sound. UK, for example, has the largest banks. France, for example, has the largest pharmaceutical companies.
Yeah.
India, just like the US, is a country which has a great mix of everything. It has cutting-edge pharmaceutical companies, some of the really up-and-coming auto manufacturers, some very good travel and tourism companies, very well-regulated banks. But what India also has, what a lot of these countries don't have, is that consumer, that big population. So that one theme, if you say, that has to stand out over the next 10 years, with all of these will, yes, definitely do well, but that one theme that we think will do exceptionally well is consumption. The Indian consumer is becoming richer. Our disposable incomes are going higher. Think about the salary that your father or my father were making, and what we are making. Salaries have just gone through. As income levels go up, it spurs spending, and that spending actually translates into big consumerism, which is why US is the economy of scale today.
Understood. That makes a lot of sense. Now, coming back to India, right? Now, India has been constantly affected by a lot of geopolitical statements, issues across China with US tariffs and other countries putting sanctions on a lot of things. right? How do you think this will affect India in the long term? And do you see them making a significant damage to the economy and or how the capital markets perform in general?
So let's just go back about a year and a half. Even before the tariffs came about, we saw a lot of foreigners pulling out money out of India.
Yeah.
We had a lot of FII outflows. These were pre-tariff, and then tariff just accelerated a lot of those foreign flows out of India. I think that has to do well with the fact that India over the last 2, 3 years was a standout emerging market, because when foreigners invest, they invest in emerging market as a pack. You hardly find a foreigner saying that, hey, I want to go heavy on India. They will invest in emerging markets. And within the emerging market pack, if India has done well, they've made a higher return. Now, that is where, when they made significant outsized gains in India, they decided to book some profits and take money back and invest it back in markets probably, uh, which had not done that well. And also the fact that they wanted a lot of money we saw going into US stocks, and we saw last year as one of the years where US ETFs just inflated in size. So a lot of money went back there. Having said that, our markets did not fall too much. We kept our markets afloat. The reason being, domestic buyers were always there to buy. Our retail buying into Indian domestic mutual funds has gone from strength to strength. When I started my career, our SIP, which is the systematic investment plan, the book there was of the monthly SIPs that used to go into the stock market was about 1,500 to 2,000 crores a month. That number is closer to 30,000 crores. And, that every month inflow into the markets has kept the market afloat. Followed by the fact that in a lot of this geopolitical upheaval of sorts, where there have been sanctions and reverse sanctions, India's probably kept its sanity. Our government's just been very stable. They've not, gone and said, hey, we want to fight the US, or we don't want to fight the US, we want to give in. We've been very stable, very calm about it. And that's why a lot of that has not really impacted us like it's impacted some of the other countries. And finally, I think India is not about foreigners.
Yeah.
India is about Indians. India is about our domestic consumption story, our domestic flows, our infrastructure, and all of that. And that's why, when you look around, we are still growing at about 7-8%. Our GDP is still accelerating. We still have sectors that are, doing very, very well. And we still have earnings that are keeping afloat. So India is more about inwards than outwards.
Got it. Now we have spoken about India, right? Let's talk about global investing. I remember in one of the webinars with Ankur, right? You had mentioned 60% of your portfolio is global.
Yeah.
Is that the case?
Yes. So a huge amount of my portfolio is global. I'm a big believer in technology. And I think technology is something that is going to drive the world forward. It's going to drive the world forward across multiple sectors, be it electric vehicles. It'll transform the way we drive and we commute. Medical technology, healthcare, the way operations are going to be done, or medicines are going to be prescribed, or surgeries are going to be done. It's just changing very dramatically. Testing there is changing very dramatically. That is driven by technology. In fact, there are companies that now are coming up with cure of cancer, which is being generated by permutations and combinations of done by artificial intelligence. Education, again, it'll get transformed completely in the next 10 years. In fact, 10 years back or 15 years back, how many smart classrooms were there? And look at even a country like India, forget Europe and the US, even a country like India, most cities have smart classrooms. So, and that'll just grow. So technology spreads across everything. I think one big thing in technology is also the fact that the world is facing an existential threat in terms of climate change. It's irreversible, right?
Yeah.
How do you minimize that? How do you change or get less impacted by climate change? By using technology into the way we generate energy, renewables and nuclear power and all of that. So I'm a very big believer in tech. Unfortunately, India does not have the world's premier technology companies.
Yeah.
The guys like Nvidia's of the world, or a Tencent, or a TSMC, or a Samsung. They're not Indian companies. I want my portfolio to be a part of those companies, of those businesses, or some of those businesses in my portfolio. I can only do that if I go global.
Yeah.
I also think China is a big market. It's the second largest economy in the world. In the next couple of decades, would end up being the largest economy in the world. If I have to have exposure to the going to be the largest economy of the world, I will have to invest in China. There are some really good companies there which are growing exponentially. For that, I'll have to go global, or my portfolio needs to go global. And I think most investors should be thinking the same. In fact, what we've seen is our home bias is so strong that 80-90% of our portfolio is in India.
Yeah.
And that is for the evolved investors. The investors are not very evolved, 100% is India. So everything is in one basket. All your eggs are lying in one basket. We've seen there are time periods that India tends to underperform with all its, tailwinds, economic progress, and all of that. There are still years that the Indian markets will underperform, and we saw something like that in 2025. India did so well in 23 and 24. We were a laggard in 25, and there were markets like South Korea, Taiwan, US, and China, which did so well. So a good, healthy mix of Indian equities with global investing is what is in my portfolio today.
Understood. And I think, like you said, even I believe that Indian investors are still yet to adopt global investing
Yeah.
as a product. They don't believe that. First of all, they're they're not aware that there's access out there to access global investment stocks funds. Second, they feel, at least from what I used to feel a couple of years back, we should invest only in India and not go global altogether. Right? I think that is now slowly starting to change the first place. Now, do you think going global is more about chasing returns, or is it managing risk over a long period of time?
I think it's about asset allocation and managing risk. Uh, let's think of it a little differently. Most investors are consumers as well, right?
Yeah.
If they are so, big on India in terms of investing, it should reflect that in the stuff they buy. If you're buying an iPhone, there is hardly any Indian company that is going to benefit out of iPhone sales. Apple's a US listed company. Foxconn is somewhere else in the world, and TSMC is supplying the chips for all these phones. So you're, in a sense, buying global products. Most investors are buying global clothing brands, whether it's Zara or H&M or any of those brands. So you're buying global brands. They're not listed in India. So when consumption is global, why should the portfolio be local alone? And because of that, if these companies are going to do well, because a lot of these companies which are outside of India are probably the best companies in the world.
Yeah.
Uh, they're doing some really cutting edge work. They're also companies which are growing very, very rapidly. And most of those companies are, in a sense, a global company. Like Amazon, for example, is a global company. It's got operations across the world. Amazon operates in about 180 plus countries. Microsoft, for example, Google, for example, a lot of these businesses are global businesses, which is the premier form of social media that people are. They have either Facebook through Facebook and Instagram, or YouTube, which is Google. So the fact of the matter is, a lot of investors are using a lot of those global products,
Products.
but it doesn't reflect it in their portfolio.
Yeah.
So it should reflect it in their portfolio as well. And now, what's actually happened is, a lot of these people uh, did not have awareness that you could invest in some of these stocks or some of these products through funds. Funds are making it very easy. Then you don't need to pick individual stock. You
Stocks.
don't need to really sit down and say, hey, should I pick a Facebook, or should I pick an Alphabet, which is Google, or should I buy an Nvidia, or should I buy an AMD? So a lot of these people are now, they don't need to buy these stocks.
Yeah.
They can buy funds which do this for them, which decide. So there are actively managed funds which buy stocks actively, and there is a fund manager who will change the portfolio accordingly. And there are passive funds. You can just buy a Nasdaq ETF or an S&P 500 ETF, which will just replicate the index that is there. So all of those products are now, awareness is coming about, but now access is also, it's very easy.
Yeah.
Click of a few buttons and you can buy some of these funds. And finally, going back to the point about asset allocation and how these companies are so good, you need them in your portfolio. So when you put all of that together, I think investors will do that over the next 5-10 years, because inherently Indians are very smart and intelligent people. Where it takes us a little bit of time, but once our intelligence kicks in, then we just take over. And I think it'll be no different in the world of investing as well.
So my takeaway of this conversation until now is, as investors, we should look at asset allocation very differently. Asset allocation is just not between products in the same country, not equity in India, not FD in India, but it could also be cross global. You could invest across borders. There should be asset allocation for both India and abroad. Perfect. Now, since we have spoken about this, Edelweiss was one of the early asset managers to introduce global funds for Indian investors. I remember a lot of the US Tech Fund, China, there's Asian Fund, and a couple of other names like Europe that you guys introduced, right? What was the thought process behind bringing that product into a market like India at a stage where global investing was not adopted, or even pretty much trivial for that matter?
So we was pretty certain that we need to, we're an asset manager who's more of a solution provider. We saw the problem. The problem was investing overseas was difficult. You had to have an overseas account and do all of that to really, really invest overseas. The second part being, obviously, markets have divergent returns, and I gave you that example that India has been a laggard in 2025. And there have been many years where Indian markets haven't done well, and there have been years that global markets have done much better than India. So investors need to have that mix. And our thought process was, if we can just give a plethora of global investment products to people through multiple geographies, what that would do is that would just start getting this global investing as a part of the portfolio going. We also wanted to do actively managed funds with somebody. And we had a tie-up with JP Morgan, which is one of the most premier asset managers globally, one of the top asset managers globally, who have over 75 years experience of managing funds and assets. So best we collect money in India by Indian investors and hand it over to JP Morgan to manage those funds and give out great returns. And that's where we have most geographies covered, whether it is Europe or emerging markets or China standalone, or even we have two funds in the US. If you're looking at a value investing, US value is a great product, but if you're looking at tech as a theme, then US technology is a very good fund to invest in.
Got it. I think after a point, these couple of these funds, at least the China and the US tech fund, in my understanding, had stopped taking investments.
Yeah.
Right? Now that we know there's investor demand, right? What do you think is going to be the next step as an AMC? Because you said you are a solution provider,
Yeah.
right? Now to solve this problem, what's the step that you're going to take to make it accessible for investors?
So one of the measures that we've taken is, as you know, there is the government of India has set up Gift City, which is a tech and investment hub by the government of India, where cross-border investments can come through in US dollars. So, you don't need to make rupee conversions. It's easier to, just straight away invest in US dollars. And there is a bit of a tax break for businesses as well there. Now, having said that, we explored the Gift City route and said that how can we, really give investors the solution for global investing, since this part in rupee investing is capped. So now you can invest in some of these funds through the Gift City route. And that is where we've launched our first product, which is the Greater China Fund, which will feed into the JP Morgan Greater China Fund, which has over a 15-year track record on our India domestic platform. So investors can invest in that one, which starts that ball rolling of giving investors access. And we've got plans to come up with a few more funds over the next 6 to 9 months for that entire bouquet of products to be available to investors to invest. Now that is through the outbound route. So investors will have to convert their INR into US dollars and invest.
Now that you have said that you have launched a fund, right? What do you think is different while launching in Gift City compared to launching in India, right? Because you said limits exist, right? And these are both outbound funds investing abroad. Why do you think the limit is there in India and not in Gift City, given that it's part of India at the same point of time and money is anyway moving out from India to abroad?
Yeah.
How is this China fund structured differently from what you have in India?
So, like I mentioned, we had a China fund in India, and the limits for which have ceased now.
Yeah.
We're only accepting 5,000 per month, which is a very small amount to have any meaningful part of the asset allocation. These limits were enforced about 7, 8 years back, where any asset manager cannot have more than $1 billion in offshore investing.
Yeah.
Once these limits were put and the Gift City route opened up, we wanted to give investors access and solution to global investing through the Gift City route. The regulator has opened up the outbound Gift City route, which basically means for Indian investors to invest overseas, they use this vehicle, and through this vehicle, they invest into overseas funds. The difference is that that same investor, if he was investing in our Greater China, Edelweiss Greater China offshore fund in India, he would be investing in INR. If he's investing in the same Gift City fund, he'll be investing in US dollars. So what will happen is from his bank account, the LR, the outward remittance in US dollars will come to us. So the investor will invest or trigger a transaction in US dollars. The INR will get converted at the dollar rate, and we will get the US dollars in our bank account, and we will invest. And on the way back, again, we will, once he places a redemption, we will redeem the number of units from the underlying fund, which is the JP Morgan Greater China Fund, and pass on the redemption proceeds to the investor. So it's just a bit of a structuring change, nothing too major. The underlying fund is the same.
Understood. Let's talk about the Greater China Fund.
Sure.
Right. Now, China has been one of the most polarizing markets in the past few years, right? Why do you think China as a country evokes such emotions?
I think people have to view it a little differently. Also, the fact that I'm a very strong believer, emotions and investments don't work together. You might not like China, but if there's money to be made, there's money to be made.
Yeah. So I think the main learning from this is we should separate geopolitical issues and business fundamentals and just focus on investing.
Absolutely.
Perfect. If you're evaluating China for your personal portfolio, what would be that one thing or signal that would have made you reconsider the entire thesis?
In terms of investing or in terms of pulling money out?
Investing.
I think I started my China investments many, many years back. It stemmed from the thesis that these guys are growing very, very rapidly. If a country is growing rapidly, that clearly tells me that the businesses within that country are going to grow rapidly as well. You know, just think about it. If India's GDP was to grow from $2 trillion, which it was, to currently close to $5 trillion, and go to $10 trillion, do you think Indian banks will not grow? They are the big beneficiaries of this entire GDP boom, right? Do you think that Indian consumption companies will not grow? If the GDP is expanding, people will consume. And exactly from that logic, I came about investing in China. I also saw the opportunity of sorts that, a basic number, the number of patents that a country files. Patents are essentially new technologies. China files more patents than any other country in the world.
Got it.
Now, if somebody's filing more patents, today's patent is tomorrow's business or tomorrow's monetizing of that business. If today I have a new technology in, say, cars, I filed a patent, I'm going to monetize that, right, at some point in time.
Yeah.
So if so many patents are getting filed, that clearly tells you there are businesses that are taking off in that geography. And I want to be part of that growth. I wanted my portfolio to be part of that, those businesses which are becoming bigger and larger and successful. And that's how that entire thesis for China stemmed out. I already had India allocation and was looking to have diversification in my portfolio. I was also looking at changing my asset allocation mix a little bit, since I had investments in US. So US investments and India investments, and if I add Chinese equities there, is a good healthy mix of diversification.
And how has the underlying fund performed over the past 10 years since you have started investing?
So the underlying fund over the last 10 years has generated about a 9% return year on year, a compounded annualized growth rate of 9%. Of that, last 5 years have been zero or no returns.
Got it.
Because China went through its own COVID, China went through a different policy mechanism where the Chinese government put a lot of regulations on their own country, and then fast forward came Donald Trump, who said tariffs on China. So China's had its own share of, a lot of stuff going around. Because of which what's actually happened is the last 5 year returns are zero. and the last 10-year returns now look at 9%. But if you were looking Chinese equity returns 5 years back, before all of this happened, they were at about 17, 18% 10-year returns, which is phenomenal, right?
Yeah.
So I think that way back of China has already started. Some of those businesses have already started moving upwards. Policies are now going back, and what we're seeing is China's out of COVID. So that's how the returns look like.
So that tells us, as investors investing in this fund, to focus more on a long-term
Absolutely.
perspective, have that perspective, could be from 10 years from now, and not look at short-term market cycles
Yeah.
that would have affected the returns at any country.
In fact, Pallav, short-term market cycles are an opportunity to invest more.
Yeah.
So if you see that India is corrected by say 30% and long-term returns for India are 15%,
Yeah.
then you should take the advantage of that correction and jump in. It's like buying in a sale, right? You go to a shop and you like a shirt that's for 3,000. You say, this is a little expensive.
Yeah.
And then they go on sale and you get the same shirt for 1,500. Nothing changed in that shirt. It's the same shirt. You liked it then, you're liking it now. You should just go ahead and buy it because you're getting it cheaper. You can in fact get two shirts for the same price.
Since the fund or even China has given decent returns in the last few years, right? Do you think this would be the right time for any investor to enter that market?
So Pallav, we discussed this a little earlier that Chinese equities have given zero returns in the last 5 years. So you have a market which is rebounding from COVID.
Yeah.
So what we've seen from data is Chinese household savings, which is essentially money in the bank, is 3 times pre-COVID levels. Now, just think about it. When we were in COVID in India or anywhere in the world, we did not go out and really spend.
Yeah.
So whatever salaries and whatever income we were generating was either getting used on very essential items, FMCG companies, basic food supplies and utilities like the internet, electricity, all of that. No one was buying a new car, no one was buying new suits, no one was going on holidays. So a lot of that money was piling up into our bank accounts. China had 3.5 years of COVID. We had 1.5 years of COVID. China had 3.5 years of COVID.
Yeah.
So their banks have ballooned with deposits. What China also had was Evergrande, which was a real estate company that went bust, and a few other real estate companies lost confidence. So Chinese stopped buying or reduced their new home buying. So new home sales really came off in China. So now you don't have an EMI outflow and you have deposits in the bank. Once the economy is opened up like it has today, all of these people are going out and spending. And I remember when COVID got over, I did 3 back-to-back holidays.
Yeah.
And Chinese are doing exactly the same. And that's why this entire consumption boom has taken off in China, which is creating mammoth earning upgrades in China. So Chinese markets given no returns over the last 5 years, so valuations are meager. Earnings are compounding at about 14%. And you have the entire Chinese GDP, which is back on track and growing at about 5%. So all these 3 things put together, we still believe that even after a 30-40% return in the last 1 year, there are significant gains to be made from Chinese equities going ahead.
And who are the people who can invest in this fund?
Anyone can who has a PAN card.
Got it. So no foreign nationals.
No foreign nationals, since they will not have PAN cards.
Yeah.
But NRIs who have PAN cards can invest. Indian residents, most definitely, most of them have PAN cards. They can invest. So anyone who has a PAN card can invest.
And do you think this is a good exposure for NRIs as well as a product?
I absolutely think so. I think you can be in any geography of the world. If you have to get the right asset allocation, you have to get China into your portfolio. And this is a beautiful product where you can invest, and especially for NRIs, they don't even have to change their INR to USD to invest.
Yeah,
For them, it's straight line.
correct. Coming a bit towards NRIs, right? As an asset manager, you would have interacted with both RIs and NRIs, right? A quick opinion check on this. Do you think NRIs sometimes are more emotional towards investments into India?
Yeah, I think patriotism comes on its own when you're far away from from your own country. It's like when you're away from a friend, you will miss the person, but when
Yeah.
you're with the person, you will probably take the person for granted. So it's just like that. So, but what we've witnessed is that NRIs are now also viewing India very differently,
Yeah.
because as they're coming back to India for holidays or visiting India for work, etc., we keep hearing from these people that this is not the India that was the India 10 years back. There's a lot of buzz, there's a lot of action happening, there's a lot more traffic on the road, which tells you economic progress.
Yeah.
uh, and also the fact that a lot of them are seeing those same trends that they saw in other markets that now India is showing. Some of the Indian companies are doing some great work. So that just builds confidence that, hey, let's invest in India.
Got it. And so again, as a AMC, now that you have given a service or a solution to RIs for investing globally, right? Are there any access routes for NRIs to invest back into India that you have introduced?
Very much. So we have introduced a product called the India Multi Manager for dedicated for NRIs. That's a product where only NRIs can invest.
Yeah.
Resident individuals cannot invest. It's again a very simple straight line product. It's a bunch of 8 mutual fund schemes. NRIs can invest in US dollars into that. We manage it. We manage the portfolio for that. And the minimum investment there is about 150,000 USD. So you can, if you want the India story, you can invest in that fund, and you can just transfer US dollars into India, and we do the rest. And when the money is needed, NRIs can pull money back. So it's quite simple. It's a very basic solution, but a fantastic start point for India allocation.
And how should these investors understand what are you trying to do with this fund?
I'm glad you asked that, because we're trying to create, again, a very differentiated solution there. So what we're trying to do is, if an Indian has to come to India to invest, they will have to invest in different funds to diversify. You don't want to put everything in one fund. Now that's where what we saw was a lot of products were investing in one particular fund, which doesn't give them too much diversification of style.
Yeah.
So if there is a portfolio manager, if there is a fund house, say Fund A, which is choosing a style of investing, there are multiple styles of investing that fund managers choose. There's growth, there's value, there's momentum, there's quality, a lot of those styles. So if you're investing everything in one fund, you are subject to that fund doing well. And if that style is not at play, that fund will not do well, and the client's portfolio will underperform. The solution that we provided here was multifold. First, we have 8 established mutual fund schemes within this one fund. So even if one fund or two funds are underperforming, the rest 6 will more than make up for lost ground. So you're getting a very diversified portfolio, not just in terms of stocks, but also in terms of styles. The second big USP is a lot of investors, NRI investors, when they have to invest in these funds, there is a lot more paperwork that is required. Now imagine you have to do paperwork in 5 different places. You rather do that in one place and save yourself a lot of time and effort. So that's the second big USP. The third one being tax. If you were calculating tax in 5 places, it'll just make your life so much more complicated rather than having one place to calculate tax. So gives you a very easy access to India, followed by the fact that in terms of the structuring, what we've done there is we've selected 4 flexi cap funds and 4 mid cap funds. So there are 8 funds, 4 flexi cap and 4 mid caps. Flexi caps are actually all cap funds which invest across all market capitalization. They'll have a bunch of large established companies. Mid-cap companies which are past the litmus test of getting established there, but they're growing very, very rapidly, and smaller companies which are good quality companies where businesses are growing exponentially. So large cap, mid cap and small cap clubbed into one is a flexi cap fund. So we will have 4 flexi cap funds, 60% allocation to flexi cap funds. So each flexi cap will have 15% allocation, and 4 mid cap funds. So each mid cap fund will have 10% allocation. Mid cap is where what we've seen is over any 5-year and 10-year period, the maximum returns are generated. So an all cap, which gives stability to the portfolio, and a mid cap, which gives real returns or alpha generation into the portfolio. So 8 funds in one fund, which also gives the investor complete India. It gives all of the best companies of India in one product with the 3 things that I told you earlier, which was style diversification, less paperwork, and tax simplification. So everything in one product.
That makes sense because a lot of these investors do not really have the, I would say, guts to churn out a fund out of the portfolio.
Yeah.
Here, at least, the fund manager is doing it for the investor in this case, right? So one more point on this, right? You mentioned the ticket size is $150,000. We have seen couple of other funds have lowest ticket sizes for sophisticated investors. Do you also have a similar facility?
Yes, so there is a facility for accredited investors or sophisticated investors who are essentially investors who have incomes in excess of 200,000 US dollar for 2 preceding years, who have a portfolio size of 1 million. So anybody who meets that criteria and their CA certifies that is an accredited investor. The minimum investing there is $10,000.
I think for NRI specifically, this product stands out a lot. Specifically speaking, being able to invest in a fund that further diversifies into multiple funds would save a NRI a lot of trouble, right? Otherwise, you would have had to invest individually into, let's say, these 8 funds to get to that point of absolute returns or risk or so on. I think there's one more angle we missed out on was the taxation. For everyone's understanding, for NRIs or for foreign nationals also as well, right, who are investing in the multi-manager fund, there are no capital gains tax applicable by the fund at the fund level or even at the investor level. Only thing they have to pay is the taxes at their home country. Yeah. So I think that is again one more less hassle to deal with.
And if you're a Middle Eastern investor or an investor out of Singapore, these countries don't have capital gains.
Yeah.
So it's tax-free end to end for these investors.
Perfect. Great, Varun. I think this is a very interesting product for NRIs. Now that you have a bouquet of products coming up as well, I think that will encourage a lot of investors to actually look at China as a market, right?
Yeah.
So this has been great, Varun. Getting your understanding of things, how you look at investing. Coming close to the end of the conversation, right? Want to have a quick contrarian round. Would love quick answers.
Yeah.
No explanations needed, right? What's one risk in global investing that you think exists that investors either are not aware of or underestimate?
I think investors are underestimating geopolitics, but you can't plan for it. So you just have to put it on the side, but that's a big risk going forward.
Do you think investor behavior is a bigger risk to returns and markets compared to the markets themselves?
Absolutely. So, like we spoke about earlier, investors chase returns. Investors don't, forget about asset allocation in times where returns are coming in one asset class, and that behavior uh, does put their entire portfolio at risk.
And if you could change one investor behavior overnight, what would that be?
I think stop chasing returns. Just keep your asset allocation intact.
Got it. Now, since we've spoken about India, China, and US, what would you suggest to an investor to what would the ideal split be between all the three countries and markets?
So each to his own, though. But if I was to make my portfolio all over again today, I would say go 20% in US equities, 10% in Chinese equities, and put the rest 70% of your equity portfolio into Indian equities. Within Indian equities, have a great balance of flexi cap funds and mid caps and small caps.
Got it. If there's one takeaway from this entire conversation that you would like to uh, tell the audience, what would that be?
I think my biggest, two pieces to the audience is that use common sense as your driving force when you're investing, and don't just follow what your next door neighbor told you. If your common sense tells you that this is a great idea to invest, do some research and figure that out, and find an advisor and invest through it. If it doesn't meet the criteria that your common sense tells you, just stay away from it.
Got it. I think that's a great note to end this conversation on. Thank you, Varun, for joining us. Thank you for sharing your views, your past experiences, your investing principles. And I hope people who are watching this learn more about global investing, take it more seriously, and consider asset allocation as the right asset allocation, the North Star metric for investing.
Sure.
Thank you.
Thanks, Pallav. Thanks for having me.